Hey everybody, what's going on? Welcome to the Financial Thing, Thursday, April 24th, 2025, live stream. Hope you're all having a wonderful week. As you can see, it's a pretty nice day here in Orlando. It's about 28 degrees, pretty warm. Hope it's not raining where you are. Anyway, tonight we are going to have an impromptu live stream with George Huntley, the CEO of the money platform. A bit of an impromptu stream. George had reached out to me a few weeks ago and said, hey, it's been a while. I'd love to come back on the stream, tell everybody about what we're doing here at the money platform. We were trying to get a date together and unsuccessfully. And then a couple of days ago, George said, hey, what are you doing this Thursday? And I said, well, I'm doing a stream if you want to come on. And he said, I would love to come on and have a chit chat. So there we are. I have been having a bit of technical difficulties with the guest streaming. So I'm hoping, fingers crossed, it's going to work okay. You know how that is. I mean, let's get right into it. Please hit that thumbs up if you can. Don't forget to subscribe to the channel if you are not a subscriber. If you have any questions for George, put them in the chat. We'll do a Q&A at the end if you have anything interesting. And yeah, not really much to say. There will be just a bit of housekeeping. I think we'll almost stream next week, and then I'll be taking off for the month of May. Having a bit of a holiday. So no streams after Thursday of next week. Will be the last one for May. The first and the last one. Anyway. But yeah, let me go ahead and grab George and then we'll have a chat about the money platform. I hope you enjoy it. George is always a good guest, so I hope you enjoy it. Hold on. Let's get him on here. Hello, George. There we go. Good to see you again. There we go. Everybody in the chat, let me know that you can hear George okay. Just leave a comment in the chat. I think you can. You should be able to hear him just fine. So, George, nice to see you again. Thank you for...
Yeah, I'm so pleased we were able to arrange.
It was very short notice, wasn't it? It was.
Yeah.
But that's okay.
Yeah, that's a lot of delays on my part, but I'm really pleased we were able to get it in.
Yeah, we can always accommodate.
It's been a while, I think, so it's really good to speak to everyone again.
It has been a while. Of course, if anybody doesn't know, this is George Huntley. He is the man in charge. Do I call you the man in charge? Are you the CEO?
Yeah, you certainly can. If you, yeah, I'm the CEO. Yeah,
the CEO of the money
platform. It's got a better ring to it.
The man in charge over at the money platform, based in London. Still, yes, London.
Yeah, absolutely.
Central, side, south, east. Where are you in London?
Yeah, central. Yeah, we're in the city. I'm actually at home right now.
Okay.
But which is also in London. Mm-hmm. But I was in the office earlier today. So yeah, we're near Mansion House, Cannon Street. And I would say, actually, if anyone ever wants to drop in, please do. We love having lenders visit us. We'll give you a cup of tea or coffee.
Open invitation.
We've had a few people in the early days. We had a few people just check us out just to see if we were real. But we haven't had that for a bit of time. So yeah, hoping that someone will come and visit us.
Okay, open invitation to everybody out there. If you want to go to Cannon Street in London and get a cup of tea and then check out the money platform, you should do that. And I always tell everybody, why not? Because that is not a lot of financial institutions do not offer that type of opportunity. So if you
I can even go one better, actually, Lawrence. We have, so we're in a WeWork office, and in a WeWork office, they give pints of beer out after 2 p.m. So if anyone comes after 2 p.m., we can even give you a pint of beer.
What kind of beer? What kind of beer are we talking here?
It's not. I mean, it's quite lagery. They've got two different types. But I think it's yeah, I can't. It changes around regularly, but yeah,
Hey,
it's
how can you beat that in the world of high inflation and tough times? Go get a free pint of beer and learn about the money platform. Can't beat that, right? I think that's great. So, quick question: are you a Londoner, born and raised, or not?
no, I'm not. No, I came here 12 years ago. No, I grew up in Herefordshire,
Herefordshire.
so on the border with Wales. It's not a place that you'd go to unless you needed to go.
Okay.
It's kind of north of Bristol, south of Birmingham.
Sounds like a lovely place. It
Yeah,
does.
yeah, it's good. It's a
It
nice
does sound
place.
like a good place. Well, let's talk about the money platform because I don't think anybody wants to hear me drivel on about Herefordshire or where you're from. No offense, but okay. For anybody that doesn't know what the money platform is, I'm just going to give you a chance to briefly explain. First of all, let's look at the borrower side because you're kind of in a unique peer-to-peer lending space where you offer lending. It's a little bit different to some of the other companies that we talk to who mainly deal with property-backed lending. So tell everybody what it is that the money platform offers first to borrowers.
Sure. Yeah, so that yeah, the money, but you're right that we are quite unique in that most peer-to-peer lenders these days do asset-backed lending, so property development or similar things to that. And we are one of, I think there's only two of us left, only two peer-to-peer lenders doing consumer credit loans, unsecured consumer credit loans. So from the borrower side, what that looks like is we serve anyone who's coming with a thin credit file or possibly an impaired credit file, and they're looking for short-term loans or medium-term loans. So anything from 2 months up to about 2 years. And our APRs tend to be at the higher end of the spectrum. Because we're taking on riskier customers. And what we've built at the Money Platform is a way of underwriting those riskier customers. So trying to find ways by which we can look at someone who maybe has a poor credit history or maybe has no credit history because they're under the age of 25 and they've never borrowed before. And we're trying to find ways in which we can underwrite those customers and pick out the good from the bad. So just to give you an example, I think last month we had actually 11 million applications for loans, which is crazy. Most of
What?
those are the same people applying every
11
day.
million
11 million,
applications
yeah, yeah,
from
yeah.
from UK strictly.
From UK strictly, yeah. And that's crazy, but it's often we're receiving the same lead, same customer multiple times, and we get them through lots of different affiliates. So it might be the same person hitting us many times and maybe applying many times. But we whittle that down to about 5,000 or 6,000 people that we lend to every month. So it's a really difficult way of trying to find the wheat in the chaff or the gold in the rubble. But we have been successfully doing it now for I think about 8 years. So
How do you go through that many? I mean, even if like it was a million applications, that's a ton, right? Do you have some
yeah.
kind of automated process that kind of whittles through the bad stuff to get to the good?
For sure, yeah, definitely. So everything is automated. We've got, yeah, I mean, going through all of those applications, I'd have to have an army of people, and we've got a fairly small team. There's about 20 of us, mostly in London, some elsewhere. We've got some developers in India. So what we're doing is we're looking, in the first instance at a few ways in which we can filter people out. So have they applied to us recently before, which is actually the majority of that 11 million have applied to us before recently. And again, they might not have heard of us, but they might have come through an affiliate or a broker. And so we've seen their application before. And we can whittle down a lot through that. There's also minimum income requirements, minimum disposable income. We have to feed all of the data into a kind of postcode lookup to try and match an address against a postcode. There's a few other checks that we do just right at the very early stage, and we whittle that down to a smaller number. The smaller number go through a credit check. So again, a lot of the customers we deal with, they don't have a credit history in the UK, or they've got a very thin credit history, or they might be credit impaired in some way. And so we're looking to whittle that list down to people that we think don't have anything obviously wrong with them. So people who haven't got recent defaults or CCJs. And then we're doing some deep dive analysis through the tools that we've got, the automated tools that we've got, to try and out of that kind of subset of subsets to pick out a few special customers. And we build a score using all of the data that we've got and all of the historic data that we've got. We build a score to score all of those that subset of customers, and to weed out the cream of the crop, who we then offer loans to. And once we've offered them a loan, they do have to go through a kind of a more detailed sign-up process, and there's a few additional checks that we go through at that point. But most of them do get through that. So that's really good.
And George, what's the product that you're actually offering on the other side of that? The investors, like somebody like me, that might want to put in some money and try to make some yield in this terribly low or lowering interest rate environment. What do you offer investors?
Yeah, I mean, it's not terribly low compared to when we first spoke, I think, a few years ago, when it really was terribly low. But now it's it is getting lower, as you say. So we have seen actually more lenders sign up recently, probably because of that. But yeah, to answer your question, what are we offering? Well, the difference between us and other consumer credit platforms that you will have seen before, like RateSetter or Zopa, is really that we don't bundle up all of the loans and give you a slice of the pie. So it's a one-to-one lender to borrower relationship. Lawrence, if you deposited money on the platform today, you would then issue loans to one borrower, and if that borrower defaulted, there would be no provision fund to pay out. So it's a higher risk, but potentially higher reward strategy that we've got currently. And the returns, I mean, we publish an outcome statement, and then we publish how we did against that outcome statement, which anyone can view online. There's a link to it on our homepage. But what it looks like in terms of what we hope to deliver to lenders for this year, it's a gross return of 15.2% for the year 24-25. And for last year, we forecast 15.4%, and we delivered 24.0%. So the returns are elevated. The risk is elevated, and there is a bit of cash drag, it's worth saying, which does reduce the returns. So we tend to issue more loans in the first kind of 18 days of the month, and then obviously customers make payments at the end of the month, and so there's a bit of cash drag as we go through the month. But at this kind of point of the month, the cash drag is fairly low.
Okay. What is the so for somebody, because honestly, I've been looking for maybe one or two new platforms to dip my toe into. I think I have an account with you. I can't remember, but I don't think I've ever really looked inside the platform. Let's say I deposit. First of all, what's the minimums to go in on a loan?
So the smallest loan that we offer is £250.
Okay.
Although we're actually moving towards kind of £300, which is as a minimum, just because we've had 250 since we launched, and that was quite a long time ago. And as everyone will be aware, inflation has been quite punchy, so we're seeing customers generally want a bit more, and we're reflecting that by moving up a bit.
Okay.
But sorry, I'm getting sidetracked. To answer your question, there is no real minimum, aside from the fact that our smallest loan is about £300. What would be sensible, I guess, is probably the question that you're asking. And we have done some analysis recently which showed that I think it's 99 or maybe it's 98% of people who have invested in more than 50 loans are in profit.
Okay.
So as I said, it's a one-to-one relationship. There's no provision fund. We need people to self-diversify themselves in order to get a lower risk of losing their money. And to do that, you've got to invest in a fairly large number of loans, and 50 is a number that we've looked at. We've also looked at whether people make a positive return if they invest in less than 10 loans, and it's much more hit and miss. Some people doing really well, some people doing really badly. If you invest in more than 50 loans, what does that take? Well, I guess the minimum bucket that we've got, I think, is 250 to 500. So if you deposited 25 grand, you would definitely get 50 loans out of that. But you probably don't need to deposit 25 grand to get 50 loans, because our loans are quite short. So the bulk of our loans are 2 to 4 months, and we might be launching a 5 and a 6 month loan later in the year. We do also have a 12 to 24 month loan, which is another thing that we'll probably talk about in a moment. But the bulk of our loans are 2 to 4 months, and so they're repaying quite quickly. So for example, if I take my wife's account, she deposited, I think, £10,000, and she's now lent over £250,000 because it's just been rolling over several years and months, and the payments come back, and she continues lending. So you can get a rolling compounding effect, which means that you end up lending quite a lot, and you end up getting exposure to a lot of different loans.
So you really in theory, to be diversified, I mean, you're talking about 12.5K to get to about 50 loans, right? At 250 a pop. Am I calculating
I suppose
that right?
if you kept your money in for a year, if you think I'll keep my money in for a year, and you're getting probably most of our loans are 2, 3, 4 months. So say on average they're 3 months. You're getting 4 different cohorts over the course of the year. And if you need, I don't know, I think you could probably get 50 loans over the course of a year with less than 12.5 grand for sure. Because if the minimum loan size is 300 or £400 or whatever, you can quite quickly get up to that figure with those monthly payments coming in and being reinvested. But it's not something, if you want to invest £500, this is probably not the right investment for you, because you probably just won't get that exposure unless you're invested for a very, very long time.
Okay.
In which case you might be hit by a default.
Okay, so talk to me about the workings. Just hang on one second. Make sure. Yeah, talk to me about the workings. So if I've got my money loaded up in the account. I got 10 grand in there. You put the loans live, and it's basically first come first serve, and whoever hits those loans when they come up gets the loan, right? And so that's where the cash drag comes from.
As simple as that, that's right. And that currently means that actually we've got some lenders with quite big balances, and they're not getting served they're getting served on the same basis as someone who deposits a small amount of money. So we might need to do a little bit of tweaking to make sure that we give a bit of credit to people who have a large balance in their wallets. But right now, it's just a simple queue. So for one lender account, you get one position in the queue, and when you get to the front of the queue, you get matched with the borrowers coming through, or the next borrower coming through, and then you go back to the back of the queue and you come to the front again.
Okay. And so it's more kind of automated then?
It's automated, yeah. You select the offer you want to make, and the offer is really just in terms of the loan size, and then we've got a separate bucket for those, what we would call the mid-prime product, which is the 12 to 24 month product. But you select a bucket, and when you get to the front of the queue, you're matched with the next borrower who comes through in that bucket wanting that particular loan, be it £300 for 4 months. If you're at the front of that bucket, you'll get matched with that loan. And then what happens, Lawrence, is you get and it's worth saying, sorry, for all the listeners and for yourself, that obviously capital is at risk, and you could lose all of your money. I don't know if you got the risk warning on this Anyway, but it's
good to mention though. Yeah,
things can go wrong, and lenders can lose money and capital is at risk. But assuming all goes well, and you get matched with a 4-month loan, the borrower will make 4 payments over 4 months, or maybe they'll pay weekly depending on what schedule they decide. And you'll get half of the interest. So the money platform as a company will get half the interest, and the lender will get half the interest. So we are fully aligned with our lenders in that we want all of our borrowers to repay. As well as being a lender myself, I'm aligned in that respect as well. But we want our borrowers to repay because we don't get paid if our borrowers don't repay. And that is a distinct difference between some of the other peer-to-peer lenders that you've got out there who get paid a loan setup fee, which is payable at the beginning of the loan. So that's quite actually relatively, I wouldn't say unique, but it's slightly unusual amongst the remaining peer-to-peer lenders that we take interest margin as our sole fee.
Oh, okay. Can you explain just a little bit more about that? Interest margin?
Yeah, so we take, by that I mean we take half of the interest, and we don't take any fee up front on the lender or on the borrower. So a lot of other peer-to-peer lenders might charge an arrangement fee when they set up a loan, and we don't do that. We charge a fee as a proportion of the interest over the course of the loan, and that is I suppose it means that we're aligned with the lender, and we're aligned with the borrower as well. We want them to succeed and repay the loan.
Okay.
Yeah.
Good to know. Okay, that's very interesting. How long have you? When did money platforms start doing this? You said, was it 8 years? That was when they did their first loan?
Yeah, so I think we did our first loan in October 2016, so quite a long time ago. So it's been a long journey. But we started off very small, just doing a handful of loans. And for the first couple of years, it was kind of quite hard to know who to lend to. And we were very reliant on historic credit performance data, bureau data, by which I mean Equifax, TransUnion, Experian data. And as we've moved forwards, we've built our own score, which we see as better than the scores, the traditional credit scores that you get, particularly for this subset of customers, borrowers that we're here to serve, which is thin file customers in the UK, so customers that don't have a credit history in the UK. Mm-hmm. Yeah.
Okay. What is the spread? So I have to ask because obviously it's unsecured lending, completely different animal to property-backed lending. What is the spread between what you guys or what the borrowers are paying, say on an annual APR, versus what lenders are getting paid? You said it could be estimated between 15, but last year it was about, you said 20, is that right? 24?
Yeah, so we forecast, I think we forecast in our outcome statement, I'll just try and find it on our website, we forecast 15.2%. Mm-hmm. Last year we forecast 15.4 and we delivered 24%. We've been ahead of our forecasts every year that we've been doing that, which has been the last
under promise, over deliver.
Under promise, right? Yeah, exactly. Yeah. But yeah, a good question. So it's a little bit complicated because our loans are very short. So the returns that I've shown there, or I've described there, and that you can see on our website are based on an annual return. And our loans, as I say, range from typically on our short-term loan, it's 2 months to 4 months. On the longer, larger loan that we offer, the mid-prime product, it's 12 months to 24 months. So it's a bit easier there to work it out. But yeah, I'll split the products into, so with the short-term product, we take, and it's the same with the longer, larger loan, with the mid-prime 12 12 to 18 month product, we take half the interest. And as I say, we expect the lender to get both the same return actually on both products, and we're working quite hard to make sure that does indeed happen. And for this year, Lawrence, what we're forecasting is that 7% of loans will default,
okay.
By which we mean won't repay, and we will not see any of that come back, and we're expecting a further 13.2% to go what we would describe as delinquent, which means that they will repay, but over a very long time period. So by the end of our reporting period, we expect them to have not repaid, but be in a position that they will eventually repay. And that's based off, historic data and what we think, the situation that we think we'll find ourselves in at the end of the period. And that will deliver a 15.2% forecast return. But as I said, in the last few years, we've been above that. We could obviously go below that, and past performance isn't necessarily a guide for future returns. Mm-hmm. But hopefully, we're constantly improving our credit decisioning, and I'm hopeful that we could deliver a better return than that. Now, for our mid-prime products, say the 12 to 18 month product, we're forecasting the same kind of returns, so 15.2%. What that will actually look like in terms of the breakdown of defaults and delinquencies is slightly different. So slightly lower defaults and delinquencies, just by virtue of the fact that the interest rate is a bit lower, and that there's a continuous earning of interest because the loan is longer. But yeah, so I suppose you could see that as a slightly different type of product, but we have grouped them together for the purposes of our outcome statement because we expect the returns to be the same.
Okay. What can you give me an idea as to what kind of interest rates borrowers are actually paying? So if they were to take a loan for 12 months, what's the range of what they would pay for something like that?
So currently, our range for the 12-month product is as an APR is 69.9 to 99.9%. And we take half of the interest. So what the best return a lender could get would be an IRR of 49.9% for that mid-prime product.
Wow, that's high. That's a lot of.
That's high. Yeah, that is high. And that reflects the level of risk that we perceive that we're taking on. Now, I've spoken about this before. I can't remember if it was on this forum, but our long-term plan is to really have a spread of different APRs, and we do have a spread within our business currently, from the kind of short-term lending to the mid-prime products, and I want to go lower and offer a wider range than we currently have. Our view so far has been the opposite of most consumer peer-to-peer platforms in the past. We've decided to start off with the highest APRs and the highest risk customers, and move slowly lower as we understand why people default, what causes them to default, and the type of person who defaults better. We've decided we're able to move down the risk curve and offer lower APRs. But we do want to offer lower APRs, and the one of the goals of the business, as well as giving good returns to lenders, is to drive financial inclusion, to allow people who are currently excluded from mainstream finance to access credit, and also to give our borrowers the best possible rate that we can deliver to them for the level of risk that we're willing to take on, not compromising our lenders' need to make a decent return for the risk that they're taking on, but giving them the best possible rate that we can deliver for them. Yeah. And that's something that we've made a lot of progress on in the last 12 months since we last spoke.
So some of the things that I hear about lending of this type is that, from people that may say, well, is this ethical, lending at those types of high APRs. But I think what people have to understand, that there are people that do need to access money and do need to borrow. But usually those APR spreads are reflective of the type of risk that the lender is taking on. So if somebody's paying 99% interest in a year, it's because their level of risk for the lender is considered very, very high.
There's a couple of things to say on that, because it's definitely an issue that we think about quite a lot. So firstly, our loans typically are shorter, and so there's less time for the money to accrue, for interest to accrue on the loan. So it might genuinely be better for someone to take a shorter term loan than say a 5-year loan, because they'll end up paying less interest on the shorter term loan than on the longer term loan. Secondly, there's actually not a very competitive market in the UK for small loans. It's the best rate that you can get, I think, at NatWest, big high street bank. Right now for £1,000 is 29%. That's the best rate you could get if you had a mortgage. Because the costs of setting up, for a prime customer, the costs of setting up a loan, processing your payments, doing the underwriting, they're all significant. They do exist. So there's not a hugely competitive market in the UK for small loans, and we're hopefully helping make it more competitive. And then finally, I think there's been quite a lot of research which has shown that actually what the problem we've got in the UK right now is access to credit for so many people, and so many people don't have access to credit. 3 million people, I think, from a resolution report last year, it was reported that 3 million people went to illegal loan sharks. So companies like the Money Platform are making progress in stopping the need for loan sharks and for illegal lenders, and that's a really important. I think we're a really important piece of the battle against illegal lenders. Mm-hmm. But it is quite hard to make the margins work, frankly, and it's not surprising that you've seen so many non-prime lenders go out of business, because lending is expensive for the company. There's a huge number of regulatory burdens and costs placed upon us, but we built a very efficient machine to assess credit, so we're doing okay.
What's the current size of the loan book today?
That is actually quite a hard question to answer, because we have a really, really quick turnover of loans. So as I say, for our short-term loan product, our typical turnover is over 3 months. So it might differ from, for example, tomorrow we'll have, for those 3-month products, a lot of them will be repaying because it's the final Friday of the month. So it will be dramatically lower tomorrow than it would have been if you'd asking me today. But it's I think a better way of thinking about it, particularly for people thinking of investing, is how much lending are we doing a month? And I think last month, I just want to check myself before I speak, but I think we did, let's have a look. I think it was roughly 1.6 million of lending last month. So that's a fairly substantial amount to be lending every month. And our loan book, because of our short-term nature of our product, our loan book is typically in the mid millions, single-digit millions, as we scale up our 12 and 24-month loan. And I think for some of your listeners, when I last came on this program, I was talking about it, but we hadn't yet launched it to everyone. It is now launched to every lender, and every lender can sign up to it on our website if they would like to lend and are eligible to lend. So that will scale the size of our loan book, but it won't necessarily rapidly increase the amount of lending that we're doing on a monthly basis.
Okay. Got it. Yeah. So your loan book is a bit of a roller coaster then, isn't it? Because you're doing all these short-term loans. But what's the biggest loan that you offer to borrowers? What's the largest amount of money they can
Yeah. So
get?
right now, the biggest amount they can get is £1,500 for 18 months.
Wow.
That's the longest duration and the largest amount. We do have options within the mandates that we've received from lenders to go a little bit higher than that. So I think up to £2,500 and up to 2 years. And that's probably something that we're going to look to do over the next 12 months. I think, Lawrence, as you know, we're very cautious. So everything we do, we test very, very thoroughly. It took us about 18 months to get our 12-month product tested, and we've just gone now to 18 months, and we've just increased it from the maximum size from £1,000 up to £1,500. So we're very modest in our incremental increases, and I suspect we'll incrementally be increasing those a little bit over the next year as we
you're doing a lot of loans then if you're doing 1.5 million of these small pieces. So you're doing like 10,000.
I've actually just next to me I've got a mug. We've just started sending out mugs to some of our lenders, which I don't know if you can see that in the screen. You probably can't. It says 100,000 loans. We've done 100,000 loans, so that's quite a big number of loans. We've actually now done. We plan to make the mugs in January or something, and they only arrived in our office quite recently. And I think we've now done. Let me just have a look at that. That would be quite interesting. I think we've now done more like 118,000 loans. So we're constantly moving forwards.
That's cool. Okay. You mentioned before about the default rate being in the 6. You said about 6%. Something like that.
7, yeah.
About
I think we're forecasting 7%.
Is that a complete write-off? Does that default mean complete? You're just not going to get the money back from people? Yeah.
Yeah. So I mean, let's rewind a year, because we've got what we thought would happen and what has actually happened. So for the 2023-24 year, we said we would have a 7.8% default rate, which is no repayments expected on those loans, kind of write them off, forget about them, get the tax break on them, all of that stuff. And it actually came in slightly lower, so it came in at 6.3%. And because of that, and when we were making our forecasts for the 24-25 year, we forecast 7.0%, which is a bit lower than what we had forecast last year. And yeah, that group of loans, we don't think we'll get anything back on. That's when we say we're forecasting 7%, that's a forecast that we think we won't get anything back on that. On top of those, there's a bunch of loans that we would call delinquent. And those are loans where we think we'll get a bit back, or we might, in fact, we think we'll get the whole lot back, up to the principal amount, but it will take many, many years to get that back. For some of those loans, it might take a few months. For some of them, it might take 5 years. So on average, it might take a couple of years. And we update our outcome statement fairly regularly, so you can see the progress on that. So if I just give you a flavor of that, we had a 13.6% delinquency rate on the first cohort that we reported on, which was the 2020 to 21 year. So that was included quite a lot of COVID times, and that has now gone down to, or when we last updated this, it went down to 6.9%. It probably will have fallen a bit further by now. So the delinquent loans, over the course of a few years, they did fall quite dramatically. The percentage that were in that category, and we saw quite a lot of them repaying.
That's really not a terrible default rate when you're considering completely unsecured borrowing. So I think that's pretty good. Let me ask you this: what's the single biggest challenge that the money platform currently faces as a business?
Good question. I think getting borrowers and lenders is the big, and getting them at the right time. We sometimes have moments in a month where we've got too many lenders and not enough borrowers, and then sometimes moments when we've got too many borrowers and not enough lenders. Getting good quality borrowers and lenders is really challenging. And then, so I think part of that was the peer-to-peer space has been through a bit of a roller coaster. A lot of people exiting and not wanting to lend their money because they were able to get high rates of return in low risk bank accounts. So that's been a factor over the last couple of years on the lender side. On the borrower side, I think, as I said, we get so many applications through, and it's just a constant challenge to make sure we are selecting the very, very best ones that we can, and pricing them effectively so that we're giving everyone the best rate so that they want to borrow from us. And when you're into these fairly high interest rates, the interest rate can be quite a big reason why people don't want to take out a loan. So trying to price it at an attractive point, which makes it worth it for them. Sure. And for some of our customers, taking a loan is pretty essential. We've had customers who, are delivery drivers or plumbers or whatever it might be, and they've got to fix their car and they need £1,000 to fix their car, and they're one of the 10 million people in the UK who don't have £1,000 sitting around in their bank account. So they've taken out a loan for £1,000, fixed their car, and that's allowed them to earn, thousands of pounds of earnings, which they wouldn't have been able to earn if they hadn't been able to fix their car. So for some people, we're fixing a really urgent need, but for other people, it's a little bit like, I don't necessarily need to take a loan or want to take a loan, particularly if it's going to have this interest rate. So coming back to what I was saying earlier, that's why we need to expand our product range a bit to make sure that those customers who are a little bit more on the fence, we can service them and give them an interest rate that's really attractive to them.
How long does it take for somebody to get a loan is it all done online, digitally? Is it fast? How long does it take?
Yeah, it's all done online. It's all digital. There's a few different, things that they need to do. So a borrower needs to validate their bank account to make sure that the money is going to the right place and the right person. They need to set up a payment mandate with us, and they need to upload a proof of identity. And that's on top of having gone through all of the credit assessment part as well. And we validate the proof of ID. And then once they've gone through all of that, we have to send them the money. So it depending on how quick the customer is and how busy it is in the office, it can take anything from a few minutes to a few hours. But we do get most of our customers apply on day one and get their money on day one. So we're pretty quick at getting money out the door.
That's good. That's quick. How is the money platform doing as a business from a profitability standpoint? Are you guys in the green? Are you running in the red at the moment? How's it going?
No, I'm pleased to say we're in the green. We've been in the green for several years now, and it's been a big focus of ours getting to profitability. So I think we've just had our third year as a business of being profitable. We're profitable. Profits are growing. Revenue is growing. We're on a kind of one-way growth and expansion track, and hopefully that will continue for many years to come. We're still fairly small. As I said, there's about 20 of us in the team, including a bunch of developers that we work with in India. So we're a small company. We like to grow sustainably, both for lenders, making sure that our lenders are getting good returns, but also for the business, making sure that we can afford to pay our bills and have that fully funded wind down plan. We're in a very good position right now, which is great.
Good. Don't forget, everybody out there who's listening, please give us a thumbs up. George has taken his time to come here and give you all the goods, a very honest, transparent fashion that George always does about the Money Platform. Again, Money Platform is a UK-based peer-to-peer lending company, meaning if you want to invest your hard-earned pounds and help other people to get loans on the borrower side, you can do that. So direct lender to borrower system. So pure peer-to-peer lending. Oh yeah, it was another thing I was going to ask you. Do you use any institutional lines, or are you strictly 100% peer-to-peer?
100%. Well, I say we're 100% peer-to-peer. You can sign up as a company lender if you would like to. So if you've got a company making, I don't know, widgets or doing consulting or whatever, and you've got a bit of spare cash, you can lend as a company on the platform. That is possible. But it still operates as a peer-to-peer platform.
So, one of the few left
system,
that's strictly peer-to-peer. That's cool.
It doesn't change if you're lending through a company structure. You're still getting access to the same loans.
Okay.
You're not treated any better or any worse. But yeah, if lenders do have a company that operates in a different sphere and they want to lend out a bit of spare cash, then happy to talk to them about that too.
Dave Dawson asked a quick question. He said, "Do you offer a ISA?"
Good question. Yeah, we currently don't. I actually had a call with someone about that today. So it's rising up the agenda, as in someone to help us set that up. We don't, and the reason we don't, Dave, is really just because we've always seen ourselves as a fairly high risk option in the peer-to-peer ecosystem, and so we've not really thought it would be right to offer an ISA, because it feels at the more retail end of the spectrum. But it's something that we're definitely looking at, and yeah, watch the space.
Okay, all right. One other question. I usually do the questions at the end, but since I can see the chat now on the screen next to me, now I can just kind of ask them as they're coming in. Do you provide comprehensive tax reports for people doing their taxes at the end of the year?
We do. Yeah, we do. I say we do because I think there's a small issue with the tax statements right now. So they're currently not available to lenders. But yeah, we have done since 2018 provided tax statements, and we continue to do that. I don't want to say that we do without that qualification of them being unavailable right now, in case that particular person is frantically trying to download their tax statement from us.
Hopefully the problem didn't happen on April 3rd or right when people needed them, right?
Yeah, I think it's January people do their tax returns. Yeah, but I know that we've got some lenders. We've got 4 or 5 who are
December. You got to do them by January.
January 31st. January 31st. Yeah. Okay. There's some lenders who are quick on it and like to get their tax returns done in April, and I know that there are some that are waiting for that. So apologies if you're one of them.
Yeah. Okay. Good. So it's getting fixed. Something that people are going to want to know is if I'm lending money to somebody and they do decide not to pay, can you give me a brief description of how do you try to recoup that loan to get lenders paid back?
Yeah, sure. So, the payment dates are fixed by the customer. We actually try and make sure that the payment dates match the customer's date on which the customer gets paid, because the best way of making sure we get paid is the money comes into their account, and we follow through on our payment mandate immediately after we see that money hit their account. So that's how we're very efficient on collecting, and that's the biggest win on collections is collecting at the right time. And that's what we're all about. But if they can't make the payment on the day, if the payment fails or whatever, then actually we see quite a high rate of people just log in and pay. So they get automated messages, emails, texts, etc., that come from our system that advise them to come and log in and pay. We've got a range of different payment methods that they can use, which is another important win, because a lot of people, maybe their card doesn't work or whatever. So we've got open banking payments is something that we added towards the end of last year to allow people to pay via a different route. Now, if they still don't log in, we continue chasing those customers internally. So we've got an operations team that will contact them regularly throughout the course of their loan if they're behind on payments. We've got a suite of messages that go out to them to remind them of the need to repay. If they've missed payments and they are a month down, we then start reporting those customers to the credit reference agencies, Equifax and TransUnion, and so their credit report gets impacted, and they might get notified of that as well, separately to us. This whole suite of messages that we have goes for about 60 days after maturity, so it goes all the way through their loan up to 60 days past maturity. At that point, we send the customer to a debt collection agency, and they progress with their collection journey, which actually isn't dramatically different from R1, but having a different email address and a different name and a different letterhead seems to have an impact, and they seem to collect some money there. So the whole kind of start to finish collection journey, I think, is, it's quite a long period of time. And what we often find is that because our loans are quite short, we do see customers fall into arrears, but then, within that quite long collections journey, they might pull themselves out of arrears. And what we also find is that so often the case, it's like a pride issue. And so if we can find ways in which the customer can make a payment, whether it's a repayment plan, moving payment dates, or whatever it might be, then we end up seeing quite good returns on those communications. It's really when you take the kind of old-fashioned aggressive approach that I think just doesn't work. We've not really gone down that route because we see quite good recoveries on our delinquent loans.
Okay. So it's kind of then the standard sort of debt collection route if they don't pay you. You're not sending Uncle Des down to knock on their door in the middle of the night, putting him in a headlock.
Yeah,
it's just
definitely not. Definitely not. No, that's the kind of thing that we're trying to eradicate. But most, because as I said at the beginning, we've got such a high number of customers. We weed out the very best, what we consider the very best customers. It's fairly rare to find someone who really just doesn't want to pay at all. Most of them have very good reasons as to why they should delay a payment or move a payment or push stuff back. Or they might enter an IVA or a debt management plan or a payment plan with us or something like that. And, a lot of those things are understandable. Our real focus is not on penalizing those people. It's on really weeding out the people who just do not want to pay and will not be in contact with us, and essentially committing fraud.
Yes.
Those are the ones we're trying to limit.
Okay. Do you somebody was asking Chimpo Naughty, Darren in Cambridge, he's asking, what is the default recovery percentage rates on loans that actually do go into late status?
Yeah, so I think I mentioned earlier we split it out into delinquency and default, and on the defaults we don't really expect any recovery, although we do see a bit of recovery, but it's not massive. So just to give a flavor of that, like if I look at a year that we haven't looked at on our outcome statement, like 2022 to 2023, it's gone down from 7.8%, our default rate 7.8% to 6.6%. But those loans that have gone into some kind of arrears, they haven't necessarily paid everything off. They might have paid something off. Those are where we expect to see most of our recoveries. And I think the example I gave earlier was falling from 13.6 to 6.9 on those. So halving over the course of a few years. Hopefully that helps in some way. We see I would not underestimate the amount of recoveries we see. So we've had some lenders who have lent with us. The loan, their bunch of loans gets to maturity, and they're not yet at break even. It's hard to describe this in words, but we follow the loan tape or collection curves, they sometimes call them, and we see a huge amount of recovery in the first kind of 4, 5, 6 months after the loan has finished, and then it tapers off a bit, but it continues going for literally ever. So we've looked recently at some of our oldest loan cohorts, and we've continued to see payments from those, well into year 4, 5, even 6, which is a bit strange because it's actually no longer on the credit file at that point.
Yeah.
But people continue to pay because they know it's on their, generally it is reported on their credit file, so it's impacting their ability to get, a telephone contract, a mortgage, to just generally move on with their lives, their financial lives, and so they know it's due, and they do often call us up.
Okay. Let's do a couple of other quick ones here. I don't want to keep you too long, even though it's very fascinating learning about the money platform because it's so different. Stuart B says, do you sell delinquent loans to debt collectors?
We've looked at it quite recently. Well, end of last year, I looked at that in a bit of detail. And we've decided we get better returns by not selling them.
Okay.
For our lenders. In fact, we as a company, we might consider in the future giving lenders the option to sell their delinquent loans to us at a kind of modestly competitive price, because we are so confident in long-term recoveries on these loans. Okay,
very cool. And Richard Weber says, is there a secondary market if investors want to exit, get their money back early?
No, there's not. There's not. Okay. And that's very worth flagging. So that's a really good question. Yeah, there is not. You are certainly locked in for the duration of the loan. The one saving grace with this type of lending, though, versus the 5-year kind of property deals that some of the audience might have lent on in the past, is that these loans are generally very short. So a lot of them are, as I say, 2 to 4 months, even 12 months or 18 months, or the longer loans that we offer aren't particularly long. You kind of know where you are quite quickly.
Okay. And oops, hang on one second. Okay. Chimpo Naughty, his funny name. Always makes me laugh, that name. He has asked, defaulted loans, what's the money platform's definition as far as how many days late is considered defaulted?
No, I think it's 90 days. I need to check that, but I think it's 90 days after maturity, yeah.
Awesome. That was the easiest question you probably answered.
Yeah.
Tonight. Okay.
Sorry, I'm very verbose. I've always got a lot to say on this.
That's okay. It's totally fine. We're happy. Is there anything else that you would like to tell people? Let me ask you one other question. They pop up on a delay. So, do you personally, George Huntley, lend any other money to any other through any other peer-to-peer platforms, whether it be through spying purposes or just to do it?
I have lent through a lot of platforms I would say I've lent on most platforms in my time. Maybe not most, that's probably a little bit of an overstatement, but I've lent on a huge number of platforms in my time. I have wound down most of my accounts just because they haven't delivered, frankly, the returns that I have been getting on the money platform. So, so I've kind of probably gone deeper into a pool that I know quite well, which is the money platform. But yeah, I do. I've had accounts with Funding Circle. I've got an account which obviously it's now being wound down, Assets Capital, which I quite liked as well, although the returns were quite low, but I suppose it was secured. I still lend a little bit on Bondora. I've lent with all of the big names that I'm sure some of the audience here will have lent with. But I'm very interested to hear any recommendations that people give me. I'm always keen to try new ones. I got into this business by being a bit of a P2P geek, so yeah, keen to find new ones. I think frankly though it's been a little bit disappointing, and so I've kind of gone more deep into what I know, which is the money platform.
So what my dad always used to say, George, he would say, stick to what you know.
Yeah.
I thought that was good advice. Anything else you want to tell people about the money platform before we wrap up? This is your time to advertise. Do you want to say whatever you want?
Just say feel free to sign up and go through the onboarding. I apologize in advance if you do sign up and you find the onboarding very laborious and boring. It is boring and laborious, and it's that way because the FCA makes it that way. But they've created a fairly safe ecosystem for people to lend now. A little bit late, but it is now fairly safe in a way. Although obviously not without risk, and capital is at risk. But yeah, no, please sign up. And the one other thing I would say, Lawrence, is that we love to get feedback. So any feedback whatsoever at all, please send it to the team, to me. You can add me on LinkedIn and send me lots of messages about what you think of us. And please spread the word as well. We really do want to be able to lend to more people, a wider spread of people, and grow this business and be able to offer people competitive rates, both on the lender side and on the borrower side. So if we're able to get more people on board with that journey, then that's a good thing for everyone.
How did they sign up? What's the web address? Moneyplatform.com?
It is just themoneyplatform.com.
There you go. Themoneyplatform.com.
So check it out. Let us know what you think. And be in touch if you've got any problems.
Wonderful. All right. Well, we've been going for an hour. It always whizzes by with you on here. So thank you again for coming and sharing all this great information. If you want to go to check them out, themoneyplatform.com, and you can reach out to their support if you have any questions, or go stop by for a cup of tea and maybe a pint of beer. Yeah, there you go. It's not too bad. So yeah, thank you again, George, and appreciate it. Hopefully we'll have you back on quicker than 2 years, and look forward to speaking with you next time. Best of luck with the business.
Great. Very good to see you, and very good to speak and catch up. Thanks, Lawrence.
All right. Thank you, George.
Bye.
Take care. Bye-bye. So there you have it. Let me put my camera on because, again, everything is different today. Oh, there we go. Let me take Richard's comment off of here. I hope you enjoyed that. Just so you know, when I do these Q&As, they are not paid for. The Q&As are because I'm interested in providing this information to you. These people do not pay me to appear on the stream, so it's not an advertising piece. But yeah, there you go. I hope you enjoyed it. I like what George is doing. He's been doing it for a while. Obviously, there is some people that may say, is it ethically okay to lend to people at those types of interest rates? Same thing as credit card companies. Yeah, I guess there's some conversation to be had about that. But then, some people need money and some people are high-risk lenders, so people have to get paid for taking on that type of risk as a lender. So there you go. But do whatever you think is good for you. I hope you enjoyed the stream. Anyways, yes, we are all George. That's a good one, Darren. I like that. So I will see you next time. All being well, back next Thursday with another Financial Thing stream. And that will be the last one until June. So come back and join us next Thursday at 7:30 p.m. UK time. 2:30 p.m. if you're watching in the US of A Eastern. And that's all I got for you. I will see you next time. Take care. Bye-bye.